Please settle a dispute I have with someone who listens to you regularly. He tried to tell me that you say a person should not own his or her life insurance policy. I wasn't having it. That doesn't make sense. Of course, I own a policy that covers my death so the benefits go where I want them to go. What am I missing here? Well, David, I've heard you say it enough times that it is true. You do say generally you should not own your life insurance policy. Take us through that again.
Yeah, all right. So you need to understand life insurance, the death benefit will pay out to your beneficiary, whoever you've listed, spouse, children, or anyone else, tax-free. So I want to make sure you understand that. However, depending upon where you live and your asset level, the death benefit is calculated as part of your estate. So here in Nebraska, we're one of 6 states that still has an inheritance tax. Now, we do not currently put that inheritance tax on the death benefit, but there are states that do, okay? And federally, it is calculated as part of your estate tax. Now, as we sit and record this today, a person can exempt basically $14 million in assets when they pass without having to worry about the estate tax, but it's 40 cents on the dollar once we go past that. So family farmers, think about that. If you have a family farm, 640 acres today, and it's worth $8.5–9 million, and you're around another 30 years, that's going to be worth $20 million when you pass. Under current law, the exemption drops to $5 million inflation adjusted next year in 2026. That's what the law says. Now, again, we'll see if it gets extended or not. But inflation adjusted, it's estimated to be just under $7 million by most economists. So if you could only exempt $7 million and your estate was worth $20 million, you're going to pay a 40% tax or even higher. It's up to 55% on the balance at $13 million. So that's $7 million in estate tax that's due 9 months to the day after you pass.
What can we do about this?
Well, so if you had $1 million life insurance policy, that $1 million death benefit is also calculated as part of that discussion, and you would give up half the death benefit, in other words, to the estate tax. So you can simply create a trust. It's very simple to do. It's called an ILIT.
Irrevocable Life Insurance Trust?
Yeah, ILIT, Irrevocable Life Insurance. It just changing the ownership of the policy to an irrevocable trust that is no longer now part of your estate. Therefore, when you pass, that death benefit still pays tax-free to your beneficiary, but it's not calculated part of your estate or inheritance taxes if you live in the wrong state. Again, it's a simple thing to do that can save you a lot of pain. Now, primarily, yes, I joke about it. You should never own it. But in reality, if somebody's out there buying their first term policy to pay off the mortgage, you're probably not having to worry about this. But the idea is when I say things, it's to do this, just that, get the listener's attention. Wait a minute, there's something I don't know here. And plan accordingly, because the legislative bodies can change these things. And if you put things in an irrevocable trust, they can't call it back, even through legislative changes. You are protected from this day forward. So it's an important topic.